Today, David and I are going to talk about a topic that we get quite commonly asked by our clients is, what does book value mean? When you get your statements, you probably notice that there's two different columns that you get. One that has market value down it and the other one that has book value. Now, market value is pretty simple. Market value is what your investments are worth at that given time. So if you were to sell everything at that given time, that would be your market value.
Book value is a little bit more complicated to understand. A lot of people have the misconception that book value is what they invested or what they put into their investment. That's partly correct. Book value is your initial investment plus any future deposits or contributions you made to that investment, minus any subsequent withdrawals after that initial purchase. Plus any reinvested dividends. So it is a little bit more confusing to understand. And in today's video, Harry and I are going to try and explain book value to you so you have a better understanding, so that when you are looking at your statements, you sort of understand what those two values represent.
Yeah, I agree, David. It is very complicated. And, one of the things I've also noticed is sometimes our clients will get statements and they'll actually see that their book value and the market value are actually the same price, or even in some other instances, their book value is a little bit more than their market value, David.
And that can really confuse people. A lot of times they'll see their book value higher than their market value. And let's say they're invested in that, they've been in this investment for a year or two, and they're looking at their book value is still higher than their market value, and they call us and say, hey, this investment's not making us, it doesn't look like it's making me any money. In fact, it looks like it's lost me money. Well, that's not, usually that's not the case. Sometimes when your book value is higher than your market value, and it's been a relatively short period of time, your investment may have actually lost money. But if you've been in a fund, say a bond fund or a monthly income fund, or a dividend fund, something that pays distributions on a regularly, either a monthly basis or a quarterly basis, as you receive those distributions, your book value increases. And so if you've been in an investment that pays a lot of dividends or distributions for several years, it's not uncommon at all for your book value to eventually exceed your market value in certain instances. And that does not mean that that investment has lost you money. It actually may have made you quite a bit of money over that period of time. So in today's video, we're just going to try to explain what book value really means so that you don't get confused when you look at your statements. So let's look at an example, Harry.
In this example, Jane makes an initial purchase of $1,000 for 100 units of an investment fund. After making this investment, Jane receives 4 distributions from her fund throughout the year. When Jane made her initial investment, she elected to have all future distributions reinvested. Therefore, as she received distributions throughout the year, these distributions bought her additional units of the fund. As you can see at the end of Jane's statement reflects that her market value is $1,040.60 and her book value is $1,040.60. If Jane were to try and calculate her investment performance by subtracting the book value from the current market value and dividing that book value, it would appear her investments made no money. This would not be correct. The correct way to calculate the performance as of December 31st, 2016 would be to subtract the amount invested from the current market value and divide that number by the amount invested. This would provide the correct performance for the investment of 4.06%. So, as you can see from this example, even though the book value is the same as the market value, the investment has indeed made money. But if you don't understand how book value works, you could easily mislead yourself to think you have made no money. So, David, if book value doesn't necessarily tell us how much profit we've made, what actually is a use for book value?
Book value is really important to track, particularly if you're investing in a non-registered account. And it's primarily used in connection with calculating your capital gain or your capital loss when you eventually sell an investment or security. Tracking book value is therefore more important for non-registered accounts versus registered accounts. Registered accounts are things like your RRSP, your tax-free savings account, or a registered education savings plan. All of those accounts are registered, meaning that they have their own tax benefits. Any investment that you own inside of a registered account, as you receive distributions like dividends or interest, you don't pay tax on those as you go. Whereas in a non-registered account, so any account that's not a RSP, a TFSA, an RESP, etc., as your investment in those non-registered accounts earns dividends or interest and you receive distributions, those dividends or interest payments are taxable in the year that you receive them. And therefore, if you've elected, as most of our clients do when they invest, to have their dividends reinvested automatically, you, at the end of the year, you get a tax slip for all the dividends that you've received, which you will then pay tax on in that current year. But you get credit for those dividends, and that's reflected in your book value. So as you receive those distributions or dividends, they're the same thing, and they get reinvested, your book value increases. So then years later, when you eventually sell your investment, in essence, you've been credited for those dividends that you received in prior years that you've already paid tax on, because your book value increases, and therefore your capital gain is less in the future, because you have in fact received dividends which you reinvested and have already paid tax on. So book value is certainly important to track, particularly for non-registered investing. It gets tracked anyways for your RRSP or your TFSA, even though, quite frankly, it's kind of irrelevant information for those accounts. It's just something that does have to get reported to you, and so it's there. But it's certainly not really that important. It is critical for non-registered investing, though.
Yeah, and as you can see from this topic, it is not black and white. It's a little confusing. So please, if you have any questions at all with that, if you want David and I to explain in a little more detail one-on-one, we would absolutely love the opportunity to do that. Stay safe.
Thanks for watching today's video.